Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. We are capping off a truly complex week in global finance. If you look at the source material we've gathered, we're pulling from CNBC, Bloomberg, Yahoo Finance. You see these two, completely contradictory stories playing out. You've got this explosive tech acceleration on one hand, and on the other, this almost shocking fragility in the physical infrastructure that holds it all up.
That contrast is exactly what we're trying to synthesize in this deep dive. How can the world be racing forward on the AI frontier and at the exact same time get pulled back by these, foundational breakdowns and major geopolitical friction? It really is a study in extremes.
It is. So we're going to be tracking the unexpected halt of one of the world's biggest derivatives exchanges, all because of a cooling issue, a true single point of failure. And then we'll jump right into Google's massive AI comeback against its Chinese rivals. We'll also explore this colossal antitrust challenge Apple is facing in India, and then look at how the UK is trying to sort of fiscally future-proof its economy. Okay, let's unpack this and start with that failure. Let's start right here with the immediate shockwave that hit the markets this morning. According to reports across the wire, trading just came to a near standstill on the Chicago Mercantile Exchange, the CME. That's one of the foundational hubs for global derivatives trading.
Right, and what makes the story so compelling and frankly a little unsettling is the cause. We're talking about billions of dollars in instantaneous transactions, high-frequency trading, and it all grinds to a halt. Not because of some sophisticated attack, but because of what the CME confirmed was a simple cooling issue at data centers run by Cyrosone.
An HVAC problem.
An HVAC problem.
A single temperature control failure. Yet the effects were massive. The outage took down key futures markets, options contracts.
And the foreign exchange platforms, too.
So for listeners who don't spend their day in the electronic trading pit, what does a halt like this actually mean in practical terms?
It means liquidity just evaporates instantly. The systems that route all the automated bids and offers, which, they underpin the price for everything from WTI crude to U.S. Treasury futures, when they stop updating, nobody knows the true price. The Bloomberg report showed that in early London trading, the bid-ask spreads for gold, which are normally razor-thin, they widened by a factor of 20.
20, wow.
That's a sign of just profound panic and uncertainty.
That's the financial equivalent of driving blind. I saw traders were describing it as flying dark. As a description, that just captures the pure terror of having zero visibility in a high-stakes environment.
It absolutely does. And think about the infrastructure. We've spent 2 decades building this interconnected global financial machine, right? Designed for speed, for efficiency. But this event just highlights that the whole digital stack relies on physical things. Power supplies, fiber optic cables, and yes,
Cooling systems.
cooling systems. The irony is staggering.
Yeah.
We're building multi-billion-dollar AI chips for the future, but our existing multi-trillion-dollar market can be compromised by a basic building failure.
And the timing of it, right. End of the U.S. trading week, right after Thanksgiving. So it hit the Asian and European sessions the hardest.
It did, and it complicated crucial commodity expirations, like for gasoline and diesel futures. It introduced this massive, unexpected risk right at the moment of settlement. And while the situation was contained, the real insight here, which a lot of analysts are pointing to, is that every advance in electronic trading just raises the stakes of a single point of physical failure.
So we're over-engineered for speed and maybe under-engineered for redundancy. Is that the question?
That is precisely the question.
That's a fascinating question about foundational security. Okay, let's pivot now from that physical fragility to regulatory heat. Let's talk about the colossal legal battle brewing between Apple and regulators in India. Apple has filed a case in the Delhi High Court against the Competition Commission of India, the CCI.
And this is a really high-stakes move by Apple. The financial exposure is just enormous. Some of the Reuters reports we've seen suggest this new antitrust law could expose Apple to a potential fine of up to $38 billion.
$38 billion. That number immediately grabs your attention. But it doesn't really make sense relative to Apple's actual revenue in India. So why is it so high?
Well, because Apple is contesting the CCI's method, they want to calculate the penalty based on Apple's global turnover, not just its Indian revenue.
Okay.
And Apple is arguing that this is, and I'm quoting here, unconstitutional, grossly disproportionate, and unjust. But for the CCI, the logic is pretty clear. To deter a company as dominant as Apple, the fine has to hurt relative to their global power, not just their local books.
So this sets a huge global precedent. for how multinational regulators can go after big tech.
A massive one.
And what was the specific trigger for this investigation in the first place?
It came from complaints filed by a coalition of Indian startups and, interestingly, major global players like the Match Group.
The owners of Tinder.
The very same. The accusation is abusive conduct. Specifically, that Apple forces developers to use its proprietary in-app purchase system, the IAP, for all transactions.
Right, the IAP, which is how Apple collects that 15 to 30% commission. It's their gatekeeper function.
Precisely. And the CCI's preliminary view is that this mandatory system restricts payment choices for developers, which ultimately means higher prices for consumers.
It's that classic tension. Apple says it's for security and quality. Developers say it's a monopoly tax.
That's the core of it. And this all plays out while Apple's strategic focus on India is at an all-time high.
Which is such an interesting dichotomy.
It is. The data we're seeing from CNBC shows Apple is just accelerating its presence in India. Record quarterly shipments, aggressively diversifying manufacturing away from China.
I saw they hit a record $12.8 billion in exports from India this year.
Exactly. So this legal fight isn't just about a fee structure. It's about setting the rules of engagement for one of the world's most valuable companies in one of the world's fastest-growing markets.
The outcome here will really dictate the investment risk for every large tech firm looking at India.
Without a doubt.
Okay, so shifting from regulatory risk to technological opportunity, let's dive into the global AI chip race. We just talked about physical failures, but the AI hardware development is moving at, lightning speed. And Chinese tech giants like Alibaba and Tencent, they're hitting these supply bottlenecks for crucial chips.
A massive bottleneck, and it's largely because of U.S. export controls on those high-end NVIDIA components. But that's forcing this huge internal domestic innovation push in China, and it's creating this opening for players like Baidu's Kunlunsen unit to become a key domestic AI chip developer.
Right.
Analysts are incredibly bullish on this. They're forecasting Baidu's chip sales to surge sixfold to over $1 billion by 2026.
So necessity is really driving explosive growth there.
It truly is.
And while China is trying to bridge that gap, Google is staging what a lot of analysts at CNBC are calling a huge AI comeback. This is with their launch of Gemini 3 and their 7th-gen custom hardware, the Ironwood TPU chips.
That term, TPU, or Tensor Processing Unit, is key. It's Google's own chip, designed specifically to run their machine learning models more efficiently than a general-purpose GPU.
And the reason it's a comeback is because of Google's full-stack advantage, right? Can you clarify what that means for the listener? Why is that such a big deal?
Sure. Think of it like this. Most AI companies buy commercial GPUs off the shelf. It's like buying a generic car engine. They then have to tune their software, their AI models, to run on that engine. But Google, because they developed both the model, Gemini, and the specific hardware, the TPU, at the same time.
They can optimize every single step.
Exactly. It's like building the engine and the custom fuel source together. They can eliminate inefficiencies that everyone else just has to deal with.
And that tight integration is obviously getting results. I saw that quote from Salesforce CEO Mark Benioff. He said the leap is insane, and that after using Gemini 3 for just 2 hours, he wasn't going back to ChatGPT.
That's the kind of quote that moves markets and directs capital. But this enormous aggressive capital spend on proprietary hardware, it also ties back into that warning we saw in the market forecasts about the amplification of the unhealthy K-shaped economy.
That's a crucial connection. So for anyone unfamiliar, the K-shaped economy describes a recovery where the top half goes up and the bottom half goes down. How does Google's AI success fit that model?
It's a perfect illustration. The upward stroke of the K is everyone who owns the infrastructure, builds the chips, benefits from the efficiency gains, the mega caps, the engineers. The downward stroke is seen in those knowledge workers, those mid-level industries who are likely to be displaced by the very efficiencies these TPUs create.
So AI is expensive to build, requiring huge capital, but it's designed to drastically cut human labor costs.
And the wealth just accrues at the very top. It's fueled by this integrated full-stack approach.
So the battlefield isn't just in the data center. It's now literally shifting to people's faces.
Exactly. Alibaba just launched its Quark AI glasses. They start around $536, and the CNBC reports say they're integrated with Alibaba's Qwen AI models for things like real-time translation.
And it can show you Taobao pricing just by looking at a product.
Right, through the built-in camera, it moves the interface away from the phone screen entirely.
Which is a direct challenge to Meta and their $799 Ray-Ban glasses.
It is. It reflects this universal belief among the tech giants that AI-driven smart glasses are the next major consumer device after the smartphone. This is the battle for the next interface.
Let's pull the lens back out to global trade and supply chain instability. If the AI race shows us the future, this extraordinary situation with the Dutch chipmaker Nexperia shows us the immense geopolitical risk of the present. The company had to publicly call on its own China unit to restore supplies.
I mean, it's a remarkable failure of communication and operation, and it points directly to high-level trade friction. Nexperia warned that its customers are facing imminent production outages.
And we're not talking about cutting-edge AI chips here.
No, not at all. We're talking about foundation components. Low-tech, but essential semiconductor parts needed for almost every electronic device.
Things like braking systems, lights for companies like Nissan and Bosch.
Exactly. So we're talking about a supply chain choke point that affects the most basic components for global manufacturing.
What's the geopolitical trigger here? What caused this?
Well, the crisis stems from the Dutch government invoking a Cold War-era law to basically take control of Nexperia.
Which, as we said, is owned by China's Wingtech.
Right. So that intervention prompted Beijing to reportedly block essential products from leaving China, creating this paralysis. And even though the Dutch government later suspended the move, the damage was done. The supply lines are still a mess.
It's a perfect illustration of how a single act of state control can ripple out into immediate, severe industrial shortages across the globe.
It is.
That link is so important for risk managers to understand. Okay, let's try to bridge that theme of global instability to domestic fiscal policy. Let's transition to the UK autumn budget, a government trying to secure its own economy while all this chaos is unfolding.
That's a good way to frame it. When global trade is uncertain, governments look inward. And the UK budget, as detailed in reports from CNBC, introduced this complex package of tax changes. It's really designed to shift capital away from pure savings and push it toward investment.
How are they trying to steer that capital?
They're actively disincentivizing cash savings. The tax-free allowance for cash ISAs individual savings accounts is being slashed, from £20,000 down to £12,000 for people under 65 starting in 2027.
So that, coupled with rising taxes on savings interest, is basically pushing people to take on more risk in the stock market.
That's the goal. It transfers risk to the consumer and hopefully boosts market liquidity.
And what about property and pensions?
On the property side, they're introducing a new mansion tax surcharge in England on homes valued over £2 million. That starts in 2028. Analysts we saw cited by Fidelity suggest it'll impact about 150,000 households and could create a two-tier market.
Right, for properties just above and just below that £2 million mark.
Exactly. Different market dynamics entirely.
And for mid-career professionals, there were cuts to salary sacrifice pension schemes too.
Yes. Starting in 2029, those tax breaks are being reduced. Any contribution over £2,000 a year will become liable for national insurance. The main effect is that it makes these schemes less appealing for employers, which experts suggest will ultimately hit mid-career workers the hardest.
Okay, let's wrap up by looking at immediate market sentiment in the U.S. and then zooming out to some of these, well, very ambitious long-term forecasts. U.S. indexes, according to Yahoo Finance, are set to end November in the red.
Which is notable because November is historically a strong month. The S&P 500 is down a little, but the NASDAQ composite is retreating more significantly.
And that's mostly a cool down in the mega-cap tech names, right?
It is. They're on track to snap these long winning streaks, which just reflects a bit of uncertainty about whether all this AI investment will translate to immediate profits.
But despite that short-term wobble, the forecasts for 2026 are wildly optimistic.
I mean, they're aggressive. Deutsche Bank is calling for the S&P 500 to hit 8,000 by the end of 2026.
8,000.
And you've got HSBC and JP Morgan projecting around 7,500. This optimism is really based on three things: continued momentum from the AI capex boom, robust earnings growth, and the big one, the expectation of future Fed rate cuts.
So AI capex isn't just a tech story. It's the main engine for these bullish forecasts. But we can't ignore those warnings about the K-shaped economy we talked about.
That caution is paramount, and it's coming from firms like Wells Fargo and JP Morgan themselves. They're emphasizing that while the market may soar towards 8,000, driven by those few mega caps, that growth is happening within an unhealthy K-shaped economy.
So AI is amplifying the problem.
It is. It's inherently polarizing. It concentrates wealth and productivity, and it creates a clear risk of a market bubble that's totally decoupled from broad economic health.
A boom based on innovation that benefits the few. That really is the central tension of the moment. We should briefly mention, too, Tokyo inflation came in a little hotter than expected at 2.8% core, which adds pressure for a rate hike there.
Right, and we also saw reports from Bloomberg noting that the Chinese EV sector faces a really challenging 2026. Government support is waning, and competition is just intensifying.
So we've covered it all today, from the complete physical fragility of a single cooling unit shutting down global finance,
All the way to the breakneck acceleration of AI chip development.
to the geopolitical friction points affecting crucial supply chains like Nexperia.
That's the synthesis. The market is trying to price in a future defined by this limitless AI growth. But the daily headlines are a constant reminder of the immense and often mundane risks that are still there. So for you, the listener, a final thought. Considering the hundreds of billions being poured into AI infrastructure, how does the sudden, simple failure of one cooling system at one data center reshape your view on the security and reliability of digitized finance? It's a profound question about physical security versus digital potential.
We'll see you all Monday morning with new headlines from major financial magazines.